Welcome to the deep dive. You've probably found yourself staring at a stock chart, wondering, why does that stock keep climbing? Or maybe, why did this one suddenly drop? It often feels like a secret code, doesn't it?
It really can, yeah. It feels like a mystery sometimes.
Totally. And today, we're cutting through that noise.
That's what we're here for, to sort of unravel that for you.
Exactly. Our mission for this deep dive is, well, to demystify the stock market a bit. We're digging into William H. Pike and Patrick C. Gregory's guide, Why Stocks Go Up and Down, really trying to get to the fundamental forces driving prices.
Right.
Think of this as your shortcut to understanding, evaluating, maybe even anticipating these movements, turning you from just watching into someone who, well, gets it.
That's the goal. We'll unpack the basics of valuation, look at how companies fund their growth, talk about those key ratios investors always seem to focus on. And then, importantly, we'll tie it all together with a real-world example, see how all this theory actually plays out with opportunities, challenges, and stock price swings.
Okay, let's jump right in then. If we want to understand why a stock price moves, where do we even start? What's the fundamental engine here?
Well, at its absolute heart, stocks go up or down because investors are basically betting on one thing, a company's future, specifically its future earnings and its ability to generate free cash flow.
Okay, so not just today's profit.
No, not really. It's much more about what it's expected to make tomorrow and the year after and so on. That forward-looking expectation, that's the real drive, the beating heart of it all.
Right. So if it's all about the future, how do we actually, put a number on that? What's the main metric people use?
The first tool, and probably the most common one, is the price-earnings ratio, the PE ratio.
PE, right.
Heard of it, yeah. Most people know the basic formula. Current stock price per share divided by the company's earnings per share. Simple enough.
Okay.
But here's the kicker. The PE isn't just valuing current earnings. A higher PE is actually the market signaling it expects better growth down the line, years into the future even.
Ah, okay, so it's like a price tag on potential.
Exactly. Not just performance today, but future potential. It's inherently forward-looking.
That makes sense. But, the market doesn't just wait around for the official earnings report, does it? There's this idea of it being a discounting mechanism.
Oh, absolutely crucial point. The market isn't looking in the rearview mirror. It's trying to be a crystal ball, however cloudy.
Right.
Stock prices move based on what the market expects to happen, not necessarily what has happened. It's constantly trying to price in or discount all the known information, rumors, expectations, everything today.
So that's why a stock can jump before the good news actually hits.
Precisely. Or why it might tank even if earnings look okay, if maybe the outlook wasn't as rosy as people hoped. It's all about meeting or missing those expectations.
Okay, so if I see a company with a really high PE, is that always a red flag? Like it's automatically overvalued? Or is there more to it?
It's definitely more nuanced than that. I mean, sometimes a high PE is a warning sign, sure. But usually, it reflects an expectation of faster earnings growth.
Faster growth justifies a higher price today.
Think about it like this. Two companies, say, both earning $2 per share right now.
Yeah.
Identical.
Okay.
But maybe the market strongly believes company A, let's call it EverConnect, can grow its earnings by, say, 16% a year for the next 5 years, while company B, Disconnect, is maybe looking at more like 6% growth.
Right. Big difference.
Huge difference in future earnings power. So EverConnect should trade at a higher PE. Investors are willing to pay more today for those much bigger earnings expected tomorrow. It's rational, assuming that growth actually happens.
That really shifts how you look at it. Okay, but you mentioned earnings per share. Can't those numbers sometimes be, well, fiddled with? Accounting choices, like depreciation.
That's a fair point. Earnings can be influenced by accounting methods. Depreciation is a great example. It lowers reported earnings, but the company isn't actually spending that cash at that moment.
So it makes earnings look lower than the cash coming in.
Sometimes, yeah. So to get a clearer view of the actual cash being generated, investors often look at the price-to-cash flow ratio.
Okay, another ratio. How
Yeah.
does that work?
Simple concept, really. Stock price per share divided by the cash flow per share. It just helps you look past some of those non-cash accounting items like depreciation to see the real money the business is producing.
Got it. Cash flow. And then there's the one that always sounds complicated. Enterprise value to EBITDA. You called it the apples to apples tool.
Ah, yes, EBITDA. It sounds like alphabet soup, I know.
A little bit. So let's break it down. Enterprise value EV. What is that?
Okay, EV. Think of it as the the total value of the company if you were to buy the whole thing outright. It's not just the value of the stock, the market cap.
Right.
It also adds in all the company's debt because a buyer would have to assume that debt, right?
Mm.
And then it subtracts out any cash the company has because the buyer gets that cash.
So market cap plus debt minus cash, the true takeover price, kind of.
Basically, yeah. It gives you a value for the underlying business operations, regardless of how it's financed or how much cash it has sitting around.
Okay, that makes sense for EV. Now, EBITDA, that gets thrown around a lot too.
Right. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Phew, okay. Why strip all that out?
Well, the idea is to get a measure of the company's raw operational profitability before you factor in things like how much debt it has, which affects interest payments, what its tax situation is, or how it chooses to depreciate its assets.
So it's just about how well the core business is performing.
Exactly. It's trying to isolate the operating efficiency.
But hang on, if we already have PE looking at earnings and price to cash flow looking at cash, why add this EBITDA layer? What does it tell us that the others don't?
Great question. It's really all about comparability.
Comparability between different companies.
Yes. Imagine you're comparing two companies in the same industry. One might have a ton of debt, the other very little. One might use aggressive depreciation, the other more conservative. They might even be in different countries with different tax rates.
Oh, okay, yeah. Their PE ratios might look very different just because of those things, even if their underlying businesses are similar.
Precisely. If EBITDA tries to strip away those differences in financing, accounting, and taxes, it lets you compare their core operating performance on a more, well, apples-to-apples basis.
Yeah.
Like comparing just the engines, ignoring the car's financing or paint job.
Okay, I think I get it. It's for a cleaner comparison of operations. So we've got PE, price to cash flow of EBITDA, quite the toolkit. But how do we actually use them? How do we decide if a stock is cheap or expensive? Is there like a magic number? A PE of 15 is good, 30 is bad.
If only it were that simple. This raises a really important point, and the answer is no. There's no single correct PE or EBITDA multiple.
Okay, so no magic number, then what?
It's all relative. It's entirely about context. To judge valuation, you absolutely need to compare the company's ratios to several benchmarks.
Benchmarks like.
Well, first, look at the company itself. What's its historical range? You mentioned DMI in the source. Maybe it historically traded between 16 and 25 times earnings when it was growing at 10%. That gives you a baseline.
Okay, its own history. What else?
Second, compare it to its peers, comparable companies in the same industry. How does R Ever Connect stack up against competitors with similar growth prospects?
Makes sense. Compare to the competition.
Third, look at the broad market. Are PEs generally high or low right now across the entire stock market? And fourth, a big one, interest rates.
How do interest rates fit in?
Well, think about it. If you can get a really safe, high return from a government bond because interest rates are high, are you going to pay as much for the riskier potential return of a stock?
Probably not. You'd want a better deal on the stock.
Exactly. So generally, higher interest rates tend to mean lower PE ratios for stocks and vice versa. They compete for investor money.
Got it. History, peers, market, interest rates, and what about just belief? How much does sheer confidence in that growth forecast matter?
Oh, it matters hugely. It's almost all about that belief, that confidence. How certain are investors that the company can actually deliver on that forecasted growth?
So uncertainty means a lower PE.
Definitely. If a company's future depends on, say, volatile commodity prices, or if it faces intense competition, or maybe its main product is getting old, investors will demand a lower PE multiple to compensate for that higher risk or uncertainty. Even if the growth number looks good on paper, reliability counts.
Right. The story has to be believable. Now, beyond just the earnings and valuation, the sources also touch on how companies finance their growth. That matters too, right?
Absolutely. How a company funds its expansion, reinvesting its own profits, taking on debt, or issuing new stock tells you a lot.
Like what?
Well, a company that can consistently grow using its own cash flow, its retained earnings, or maybe some smart borrowing, that often signals a strong, healthy business. If a company is constantly selling new shares just to keep growing.
That dilutes existing shareholders, right? Makes their slice of the pie smaller.
Exactly. It could be a sign that the core business isn't generating enough cash on its own. So those financing choices definitely feed back into how investors perceive the company and value its stock.
Okay, this is all great context. To really see this in action, let's pivot to that real-world example. Abbott Labs. The source material uses it to show how even big, successful companies face serious pressures. What was going on with Abbott?
Right, Abbott Labs is a good case. They were and are a major player in healthcare. But around the 2011-2012 period mentioned, they were facing some pretty significant headwinds.
Like what?
A big one was the patent cliff across the whole pharmaceutical industry. A huge number of blockbuster drugs, we're talking maybe $50 billion in annual sales industry-wide, were losing patent protection around that time.
And when a patent expires?
Generic competition floods in, prices plummet. Sales and profits for that drug can drop dramatically. For a company relying on those drugs, that obviously casts a huge shadow over future earnings expectations.
Ouch. Okay, so industry pressure. Did Abbott have specific threats too?
They did. Their own mega-hit drug, Humira, used for things like rheumatoid arthritis, was facing a potential new competitor from Pfizer. And crucially, Pfizer's drug was supposedly going to be an oral pill.
Ah, and Humira is an injection.
Right. Patients often prefer pills to injections, understandably. So the fear was this new pill could seriously eat into Humira's market share and, maybe more importantly, its really high profit margins. Again, it's all about that future outlook taking a potential hit.
Okay, so the pressure's on, patent cliffs, new competition. What did Abbott's management do? How did they deploy their capital in response?
Management has tools. One common one is share buybacks. If a company has extra cash, it can buy back its own stock from the market.
Why do that?
Fewer shares outstanding means that the company's total earnings are divided among fewer shares. So earnings per share EPS goes up for the remaining shareholders.
Makes each remaining share more valuable, theoretically.
Exactly. Peter Lynch was famous for highlighting how effective buybacks can be. Abbott was known for raising dividends, but they also use buybacks.
And they also hinted at something else, potentially more drastic, like breaking up the company, spin-offs.
Yeah, that was interesting. Management announced a new way they were going to report results for different business segments. Analysts often interpret that kind of move as signaling a potential spinoff or maybe even selling off certain divisions.
Why would they do that? To unlock value.
That's the term, yeah. Sometimes different parts of a large company are valued differently by the market. Maybe a fast-growing division is being held back in valuation because it's lumped in with a slower-growing one. So, by spinning off a division like Bristol-Myers Squibb did with Mead Johnson Nutrition, you let each part trade as a separate company. The idea is the market might then assign a higher combined value to the two separate pieces than it did to the original whole.
Letting each part shine on its own, basically.
Sort of, yeah.
Okay.
Allowing the market to value each business based on its own merits and prospects.
Okay, so buybacks, potential spin-offs. This all comes back to managing those market expectations we talked about earlier, right? How did this play out for Abbott stock?
It absolutely connects back. Remember, the market anticipates. So even if Abbott reported really strong quarterly earnings, if at the same time they gave guidance suggesting future earnings would be flat or lower than expected, the stock could still fall because the future story changed.
The good news was already priced in, or the future outlook trumped it.
Right. And conversely, sometimes you see a stock that everyone hates, a low expectation stock, maybe reports earnings that weren't great, maybe they even missed estimates slightly. But the stock actually goes up. Why? Because expectations were so low, maybe people betting against the stock, the short sellers, get nervous and decide to buy back shares to cut their losses. That buying pressure can push the stock up, even on seemingly bad news. It's a fascinating game of expectations.
It really is. Okay, beyond earnings, cash flow, and these big strategic moves, what about just basic financial health? Are there quick checks investors do?
Definitely. You want to make sure the company's fundamentally sound. People look at profitability metrics. Return on assets, ROA, is one. How much profit does the company generate for every dollar of assets it has? Abbott's ROA was around 12%, which was pretty decent for its industry.
Okay.
Then there's return on equity, ROE. How much profit for every dollar of shareholder equity? Abbott's was much higher, around 28%.
Why the big difference between ROA and ROE?
Often it's leveraged debt. Using debt can magnify the returns on the shareholder's equity investment. As long as the company earns more on its assets than the debt costs, ROE gets a boost. It shows that leverage effect.
Got it. So profitability checks. What about just, can they pay their bills? Short-term stuff.
Yeah, liquidity. You look at the current ratio, current assets divided by current liabilities, and the quick ratio, which is similar but excludes inventory, since that can sometimes be harder to turn into cash quickly.
And Abbott looked okay there.
Yeah, their ratios were strong, like 1.8 and 1.6. It suggested they had plenty of cushion to cover their short-term obligations. And for efficiency, you might glance at asset turnover, how much sales they generate for each dollar of assets. Abbott was generating about $0.60 in sales per dollar of assets, which was pretty typical for their sector.
Okay, so quick checks on profitability, liquidity, efficiency. Good to know.
Mm-hmm. Just
Yeah.
part of the overall picture.
Oh, we've covered a lot of ground.
Yeah.
From the absolute core driver future earnings expectations through all these ratios like PE, cash flow, EBITDA,
Yeah.
and seeing how context matters, history, peers, the market, and then diving into the real world with Abbott Labs, seeing how industry pressures, competition, and management strategy all feed into that market expectation game.
It really is a dynamic puzzle. It's not just one number. It's how all these pieces fit together. Company performance, industry trends, the wider economy. They all play a part.
So it's clear understanding why stocks go up and down isn't some dark art. It's about, well, doing the homework, analyzing the future potential, using these tools, understanding the context, and watching how the market reacts.
Exactly. You're learning to read the signals to understand the story the market is trying to tell about a company's future. It's about becoming a more informed analyst yourself.
So maybe the final thought for everyone listening is this. Next time you see a stock making a big move, soaring or plummeting, pause for a second. Ask yourself, what expectation about the future just changed here? What underlying fundamental driver is really making that happen? The market's always telling a story about tomorrow. The question is, are you ready to listen more?